Good morning to all of you. Previously you've learnt about GAAP and accounting concepts. Today we are going to continue to look at Chapter 2, Basic Accounting Concepts under Subtopic 2.3 Accounting Equation. Subtopic 2.4 Double Entry System. The learning outcomes you learn accounting equation are: to describe the accounting equation for service business, and to define assets, liabilities, and owner's equity. The learning outcomes you learn double entry system are to explain the double entry system, and to describe about debit and credit on asset, liabilities, capital, revenue, expenses, and drawing. This relationship is the basic accounting equation. Assets must equal the sum of liabilities and owner's equity. Liabilities appear before owner's equity in the basic accounting equation because they are paid first if a business is liquidated. The accounting equation applies to all economic entities regardless of size, nature of business, or form of business organization. Accounting equation can be expanded to show detail of owner's equity. Owner's equity are owner's capital plus revenue less expenses less owner's withdrawal. What is asset? Assets are resources a business owns. The business uses its assets in carrying out such activities as production and sales. Assets are divided into two. First, non-current assets. Assets that have a life of more than 1 year. It can divide it into three. 1. Tangible assets or fixed assets. It can be seen physically. Example, buildings, vehicles, and equipment. 2. Intangible assets. The asset that cannot be seen physically. Example, trademarks, patents and copyrights. 3. Long-term investments. Example, fixed deposits for more than a year and the purchase of bonds. The second one is current assets. Current assets exist in one accounting period and can be converted into cash within a year. It is constantly of changing form and value. Examples of current assets are inventory, accounts receivable, cash and bank. Bank refers to our money at the bank. Next, liabilities. What is liability? Liabilities are debt or business's obligation to be paid by business entity to another party. Liabilities are divided into two types. 1. Non-current liabilities excess more than 1 year. Where debt to be settled within a period exceeding 1 year. Example, long-term loans and mortgage. Second, current liabilities. Current liabilities are debt due in less than a year. Example, accounts payable, expense payables and unearned revenue. Next, owner's equity. What is owner's equity? Owner's equity is the ownership claim on the business. It is equal to total assets minus total liabilities. Owner's equity is often referred to as residual equity. The elements involved in owner's equity are: 1. Capital. It consists of assets in the business by the owners, and it will increase the owner's equity. 2. Drawings or withdrawals. Owner takes asset, cash or merchandise, for his own use. This will reduce the value of owner's equity. 3. Profit is generated when income is deducted by expenditure. Therefore, expenditure or expenses will reduce the owner's equity, while income or revenues will add value to the owner's equity. What is revenue? Revenue is income from the sale of goods or services to customers. It is based on the concept of revenue recognition. Two types of revenue. 1. Operating revenue from business main activities. Example, sales and service revenue. 2. Non-operating revenue from a side activity. Example, interest income, rental income, and gains on sales of fixed assets. Next. Expenses. What is expenses? An expense is the money spent or cost incurred in an entity's effort to generate revenue. Expenses use up assets or create liabilities in the course of operating a business. Expenses will decrease equity. Two types of expenses. Operating expenses. Example, utilities, sales commissions and delivery expense. Non-operating expenses. Example, interest expense and property taxes on the administrative office building. Next. Subtopic 2.4 Double Entry System. Accounting uses the double entry system, which means that we record the dual effects of each transaction. As a result, every transaction affects at least two accounts. It would be incomplete to record only the giving side, or only the receiving side, of a transaction. Rules of debit and credit. Account asset, expenses, and drawing recorded as debit when they increase and recorded as credit when they decrease. While account liability, equity, and revenue recorded as credit when they increase and recorded as debit when they decrease. The normal balance for account asset, expenses, and drawing are debit and the normal balance for account liability, equity, and revenue are credit. Thank you. That all for Chapter 2.